Well, hello again. Hi, neighbor. Won't you be my neighbor? Hi. Back again, Sunday morning. Happy to be with all y'all coming to see my channel. Yeah. Hey, you know what? No, you don't know what. I'm going to tell you what. So here I am on StreamYard, a little bit of a new service here because I was feeling a little bit embarrassed watching the replay of my last one. And when I was sharing the screen, it was so small. I was squinting and I was like, you know what? This is no good. So talking a little inside baseball with my buddy Ryan Williams, and he's been on StreamYard. He's had no problems with it. I liked how it looked. So here we are in here we are in StreamYard. Eh? And what's up again? I am Russ, and this is my little old channel, Dapper Dividends. Thank you for coming back. And we'll get to the Q&A, a little bit of live chat in a minute. I have a few things to share with you, what y'all clicked for. And check it out. I was actually just reading some news. They think that the CHIPS Act is going to pass here, or they're at least going to vote on it coming this week, maybe as early as Tuesday. So let me do this now. I want to share you one thing, or show you one thing, and that's going to be Capital Trades. I don't know if you guys have been to Capital Trades or not, but you should check it out. It's here in the United States. They track what all the politicians are sharing here. Yeah, see, that's a little bit better. So I got my phone here. I was hoping I'd show picture in picture. Hold on. You know what? Here we go. This is what I need to do. Oh, yeah. There we go. That's the stuff, right? There we go. I'm on a 10-second. No, you're on a 10-second delay. I'm not on a 10-second delay. So let's let it catch up here. And oh, that looks so much better. All right, you guys will be able to see here. So, and by the way, you got to look at StreamYard, what that looks like. And what did I do here? Anyway, so here we are. What's trading on Capitol Hill? Now, it's really interesting because I wanted to show you a few things on this before we get into the 5 dividend stocks that have high growth, which I'm buying one of them if I get some more money into my Roth. But I like to sort. You can click on trades. And again, this is you can sort by politician and whatnot. But if you go to asset types, I just like to scroll down and put in stock. You can do stock options too, because that's what Nancy Pelosi did. And then, of course, the way it works is they have to disclose, and it can be anywhere from 2 weeks to a month lagging. So we're not seeing what these politicians are doing in real time. But I thought it was interesting that Intel popped up. Shelly Capito, who is what is she? Red, right? That's Republican from West Virginia. She bought some Intel. Oh, no, I'm sorry. My goodness. So let me do this. It's still early. Waking up. Welcome. And we want to see what they bought, right? So we're going to go to transaction type and put buy just to make it a little bit easier. So she sold Intel. But what I wanted to get was, this is the one that jumped out right here. Nancy Pelosi, she exercised some contracts. So if you click on this, we can see that it was her spouse. If you do details, it'll show the owner. So spouse, I'm going to show you Ro Khanna in just a minute, but on June 17th, her husband, Mr. Paul Pelosi, exercised 200 call options of NVIDIA at $100 a share. So kind of interesting that in her last 3 trades were, oh no, she sold Apple and sold Visa. So that's interesting. We always know that people can sell for a myriad of reasons, but they buy for just one. And that is because they expect the share price to go up. So Nancy Pelosi bought some NVIDIA. They exercised some options. It's kind of interesting that we have this vote going on. So the CHIPS Act is going to be an infusion of government money into several companies here in the United States to build foundries and start making the chips right here on American soil. So we can see that. So Tommy Tuberville, who was I was looking at earlier. So there's a ton of them. He bought NVIDIA. Let's see, Jim Langevin. Don't know him. He's a Democrat from Rhode Island. He's in the House. Here. Anyway, we'll click on one of those because I think I was looking at there he is. Rokana, just a ton of moves, but you got to pay attention because it's not just for him. If we get more details, we see over here that it is for his child. So he's done a lot of moves for his kids. He still has to disclose it. And I don't know if they show what type of account it is, but they show that he was doing it for his kids. So pretty interesting thing. Again, capitaltrades.com. You can see the biggest players. This is just their landing page. And it's really really interesting. They'll show the most traded companies, which currently is HCA. And yeah, so definitely, definitely, if you want a little bit of insight, check that out. With that being said, I'm going to take a sip actually of my plug. I'm still sharing the screen. That's fine. You can't see. I'm really small. Hello up there. This is bubbly by PepsiCo. So, all right, come on, dude. We're busy. Get to it. Number one. There we go. Let's full screen this bad boy. Boom. Oh my God. What am I doing? Am I hitting F11, is it? There we go. I think I was hitting airplane mode. For Christ's sake. This freaking guy. Anyway, so here we go. I'm going to go through these quick. I have a tendency to try to run on. So we can come back to these if you have any questions or you want any more elaboration. I'm just going to show you this front landing page, and then we're going to look at their dividend growth. And that's all I'm going to show you just so we can move these along a little bit quicker. They're ideas. Again, you should be exploring things on your own. Let me know, though, if you wanted me to go deeper, because I don't want to spend 5 minutes on each one. It'll take forever. But we can come back, and I just want to share with you a few ideas of some companies that I think are good buys right now, meaning that they're on sale. And the criteria I use for this is they have a dividend safety score of 90 or higher. They have at least an 8% 5-year CAGR, compound annual growth rate. They have at least a 2.25% yield right now at the recording of this video, and their 5-year dividend yield, their current dividend yield is above the 5-year average, and their current PE is below the 5-year average. So I have 5 companies. First up, Texas Instruments, dividend safety score of 90. I think most of us know what they do. They are also a chip manufacturer. They think are the biggest analog chip manufacturer. So they're going to benefit, I think, 2.87% current dividend yield. 148 billion mega cap, go to dividend growth, and we see that they have been growing their dividend for 18 years. Their last increase in September of 2021 was very fast, but a 5-year CAGR of 21% and a 20-year CAGR of 22%. They've been growing that dividend pretty quickly. 18 years, according to this, of uninterrupted growth, and 33 years that they have not missed a dividend payment. And the payment details is $1.15 per share per quarter, $4.60, excuse me, per year. And currently the dividend is 12% above the 5-year average. And their current PE is 18.4, which is below the 5-year average of 22.1. That's that wonderful, wonderful, hard-hitting public school trained mathematical analysis that I bring to you. I know from my public schooling that 18.4 is below 22.1. I can say that with the utmost confidence and competency. They have a 52-week price range of 148 to 201. So they're at 160 at this recording. So they're pretty close to the low end of their 5-year. Next up is the one, the only Lowe's. Do you shop at Lowe's? I really don't. I'm more of a Menards type guy. I don't know if there's Menards by you. They're everywhere. But Lowe's, by the way, when I go in, pretty clean, pretty put together. I know they bought Craftsman, which I was particular to because I liked to go into Sears as a kid. Dividend safety of 93, current yield 2.27%, and 1.18 billion mega cap. So they're another huge company. Lowe's, I think you know what they do, home improvement. And what I liked is when I listened to their last earnings call, they're trying to get into the pro side a little bit more. So really trying to tap into what Home Depot does. And Home Depot is pretty heavy into contractors and catering to contractors. So Lowe's is really trying to grab some of that market share, which I like from them. As myself, I'm a contractor, and I said our purchasing agent at our company has been actually hitting up Lowe's a little bit more. They have, I think, a rewards program, a pro rewards as well. And their current dividend growth, check that out, 31% increase in May of 2022, 18% 5-year CAGR, and 24% 20-year CAGR. Just solid. They are dividend king, 59, just about 60 years of dividend growth, and also 60 years almost of uninterrupted dividends that they haven't missed a payment. Jesus, you see, I can't drink the bubbly. It's making me bubbly, everybody. I know I'm bubbly normally, but you don't need to hear my bubbliness. So we got $4.20 annually. And again, they just hiked that from 80 cents all the way to $1.05 a share. And the current dividend yield, 27% above the 5-year average. And their forward PE is only 13.4. So that means that you're going to be paying $13.40 for every $1 of Lowe's earnings, which is just fantastic. And they're pretty close to the low end of the 52-week range. They had been as high as $261. And one thing I will show you, though, is their free cash flow payout ratio, only 32%. Yeah, it's been ticking up. It was at 19%. And I don't know why it was at 59% in 2020. I don't know if they had an acquisition or they did something there. That, if you know why, let us know in the chat box. So that was 2. So we got TXN, Texas Instruments. We got Lowe's, ticker LOW. And this guy I'm probably going to buy more. Snap-on. Again, this is in my wheelhouse. So Lowe's and Snap-on. I work in the commercial loading dock industry, so I'm pretty familiar with both of these companies. Snap-on, 99 safety score, 2.87% dividend yield, $10 billion market cap. They last increased their dividend 15% in November of 2021. So that right there is pretty solid, but it's in line with their 5-year CAGR of 15% and 20% CAGR over the last 9 years. They do a lot of, aside from tools, a lot of diagnostics. You might keep an eye open, because once you've been made aware of something, you will see it everywhere. And I see Lowe's trucks everywhere. So keep an eye out. 12 years dividend growth streak. 29 years they have not missed a dividend payment. The current $1.42 annually, $1.42 quarterly, $5.68 annually. So that's just really solid company. The timeliness, the dividend yield of 2.87 is 20% above the 5-year average. So that's solid. The 5-year average, 2.39. That's nothing to sneeze at, nice little bit of growth going on. Only a 12.2 forward PE ratio, which is below the 5-year. And again, like most of these we've been talking about, toward the very low end of the 52-week range, which went from 191 to 231. They're at 197.87 as of the recording of this video. So Snap-on, I've been buying them in the bridge, and I keep putting it off because I'm waiting for them to drop a little bit more. So we got TXN. I got my notes. I was like, we got Pelosi, we got TXN, we've got Lowe's, we've got Snap-on. And next up is good old Comcast. Kind of surprising, right? So Comcast, you know them, cable, satellite, bringing you all those. They're not Peacock. That's NBC. I don't know. I should know a little better about this. Hey, did you know they own the Philadelphia Flyers as well as the Wells Fargo Center Arena? I didn't know that. Yeah, Peacock. What did I say? Did I say Peacock? No, I don't know what I said. Yeah, so they own the Peacock streaming service. People are like, what is this guy doing? He's crazy. Yep. Also, I don't, NBC Universal, theme parks, they own. All of a sudden, the dude just developed a list. We didn't know a lisp and a list. We didn't know what was going on. So they do own the Universal theme park. So look at that, dudes and dudettes. If you wanted to get exposure to the Philadelphia Flyers, you would buy Comcast. You get exposure to Peacock, the Philadelphia Flyers, and the home arena they play in, the Wells Fargo Center, and Universal theme parks. You got it there in Comcast. So they're bringing in the bank. And what about that dividend, though? What about the dividend, Russ? 13 years uninterrupted growth, 8% increase in January of 2022, but that CAGR, 13% over the last 5 years, 16% 10-year CAGR. So definitely nice, definitely increasing that dividend. Currently paying $1.08 per share annually, which is 27 cents per share every quarter. And we just missed the ex-div date a few weeks ago. Timeliness, look at this. Look at this madness. The dividend yield is 33% above the 5-year average. So that's pretty stout. And that forward PE of 11 is way below the 5-year average of 14. And again, they're buried toward the low end of the 52-week price range. So, this looks like a really interesting company. I know the streaming wars, that's big. But what I love that Netflix doesn't have, right? They do have, again, the Flyers and the theme parks on top of several other things that we're not going to get into in this video. And then last but not least, everybody, is good old Medtronic, ticker MDT. Dividend safety score of 99, current yield of 3.05%. And check it out. What are we checking out, Guy? Well, I'll show you what we're checking out, everybody. We're checking out their dividend growth of 44 years. 44 years continuous streak. They're on their way to being dividend kings. And I imagine like a crown. If I was editing this, I would just, ting, put the crown up there. But they're not a king yet. So we're not giving them the crown because we don't know what's going to happen. 44 years dividend growth, 44 years uninterrupted, 7.9% growth in May of 2022. So that's currently not outpacing inflation, but I think we're seeing inflation start to walk back. I just filled up my gas in, I think it was Plainfield or Oswego, Illinois. I think my wife can hear me. I think it was Oswego, and it was under $5 a gallon. So I was like, all right, we're starting to come down a little bit. So I think inflation's coming back. It's going to start walking down, I hope. And 8% 5-year CAGR, 13% 20-year CAGR for Medtronic. And let's see, their payment details, $2.72 a year, 68 cents a quarter after that increase from 63 cents. Did he just roll his R? He did. A 63. And the timeliness, what you want to see, dividend yield, 40% above the 5-year average. I mean, this is getting in on a potential dividend king early. I think the forward PE of 16, below 18.4. But check out the 52-week price range. Buried. Again, all of these have been buried to the lower end. Now, it can certainly go much lower, but we know it's been as high as $135, and it's currently $89.12. It had been as low as $87.40, so it's right at the bottom of the 52-week range, and looks like it could be a good position here. And what I did want to show you fine folks is Medtronic. Let's not put it in airplane mode. Make this a little bit, God bless it, I did it again. I need function F11. I was looking at some of Medtronic, what they do, and dude, they're everywhere. They have a ton. This is all their products. And here, let's go to general. I think that's what I was looking. Diabetes, digestive, ENT, ear, nose, and throat. So if we were to look at their electrosurgical hardware, this is what Medtronic does. Just stuff like this. I know Darth Dividend. I'd love to hear his opinion on this. He is a registered nurse, I believe, or nurse. I'm sorry, dude, if that's wrong. But I mean, just there you go. All this stuff, ablation systems, it is what Medtronic does. So feel free to look on their page and look at everything they do. I mean, my God, look at this. Hey, if you're bored this weekend and you want to play around with some vessel sealing, you'd go shopping at Medtronic and you could get a blunt tip open and laparoscopic sealer. Hey, people are weird. I don't know what kind of weird stuff you're into. Maybe you like sealing your vessels. Anyway, so that's it. This guy's getting goofy. It's getting hot down here, everybody. And that's it. So those are the 5 companies. I'm going to stop sharing my screen here. I don't remember how to do that. Oh, there we go. All right. And we're back. So we had Pelosi buying NVIDIA, the Pelosi's, Mr. Paul Pelosi buying, exercising all those NVIDIAs. The 5 were TXN, Texas Instruments, Lowe's, Snap-on, Comcast, Medtronic, and here we are talking with you now. So I love it. Look at this. All right, so I think I might do this different. I'll just say hello to everybody that's been saying hello. Good afternoon, good morning. Oh, Shamir. Yeah, sure. So I can just do this, right? Again, I'm on StreamYard, so you can see the little duck with the earbuds on up there. And that picture is a little weird though. I seem to be elongated. I don't know why. Maybe I need to go back to this. I don't know. Anyway, yeah. Buying the bubbly PepsiCo product. Mm-mm. I need a cough dump button because bubbly makes you bubbly. Yeah, Steven, what's up? Metal Stacking, Citizen. I don't want to say your name. I almost said Citizen and I have talked a little bit. We're going to eventually do a collab, I think next month. He has a YouTube channel as well. Definitely check out. I'll put him up there. Citizen of the Year. Yeah, I don't know, dude, if you wanted your name out there. He is a faceless and anonymous channel. So you got to be careful. I know I've talked with some of my fellow YouTubers. They want to remain anonymous and they just want their voice out there. So I need to respect that. And yeah, Shamir, I put that up there. I put you up there already. I love this. Stevens, $300 at Lowe's. Yeah. I don't know, for whatever reason, there's the bubbly saying hello. I don't know. I'm more of a Menards and Home Depot's close to us. And then Harbor Freight when I need cheap tools for a couple things. Does anybody else shop at Harbor Freight and get their wonderful Pittsburgh brand? Everything's just China made. Everything is cheap. It's cheap Chinese crap. But hey, it gets the job done until it breaks. Yeah, great point. I forgot about that. So Steven, I believe it is. I know there's another Steve C, but I think you are the Navy veteran as well, right? So I'm a Navy veteran, and yeah, 10% discount to veterans as well. That's a good point. I forgot. I think Home Depot does that too. I think Lowe's held up last recession, more resilient than other retailers. I will look really quickly. I won't put it on, but their recession return was. I will put it up. Let me see. I think I can do the share screen. Let me see if this works. Shift plus S. So if you guys can see this, their recession sales were negative 3.3% in the 07 to 09. And the overall market recession return was negative 55%. Lowe's was negative 52%. So they were just a little bit better than that. That didn't work. They lied to me. They told me the hotkey was Shift plus S shares screen. You lied. You're all out of lies. Here, let me just do this. Don't show that again. Sorry, guys. I'm still working through this. You know me. It's probably a running joke by now, and I don't even care. There we go. So this is what I was just reading from also on Simply Safe Dividends, is that they increased the dividend during the recession. Obviously, their recession sales negative 3.3%, and the recession return was negative 52%, which was slightly better than the S&Ps at negative 55. But again, if you're not selling, I really don't care because we know it's going to come back during recessions. We know it comes back. So yeah, that's they held up good in my pace. Did it? You know what? You're right, Steve C. With Comcast. That was an 89, wasn't it? I think I made an exception. You're right, buddy. I gave it the benefit. I meant to say that too, and I totally forgot. That was going to be one of the things I was going to say is that, yeah, it's an 89, but hey, I still liked some of it. It gave me some stuff to talk about, and I still think it's a pretty cool company to invest in. But um, yeah, yeah, you're right. You're right. So it broke one of my rules, and I don't know if you guys caught it, but during my last stocks going ex dividend, I believe I said that they were all stocks that were below their 5-year PE. And I noticed there's like two or three that were above. Hey, I can't catch it all. I'm busy, but nobody called me out on it. So I'm calling myself out on that one. But still, I think there's still work to be done. All right, Ben, I'm going to go through these quick. CMCSA does own Peacock. I was right on that. Shamir, not a Flyers fan. I had a question for Shamir, something Canadian. I don't remember what it was. It might have been. I've been doing monthly dividend stuff. No, I don't think it was that. By the way, Michael from Sweden, I think it is, asked me to do. Yeah, he was so kind enough. He left me a super chat last episode, and he wanted me to do a monthly dividend stock video. So I'm gonna do one. I've got it about halfway put together, and it's gonna be 4 monthly dividend stocks that I think are a good buy right now. And blurry screen. Let me see. Yeah, I don't know. Mine doesn't look that blurry. Okay, good. The two Steves. I'm getting confused. Yeah, so like I said, it's StreamYard, and I don't know. I still think it looks weird, but I like the way that when I shared my screen, it filled the whole screen because whatever restream, and unless I missed it, I didn't like that at all. So I think it's a lot better being able to show the whole screen. Let's see. Steve C. Sven Cardinal, 100 stocks from VYM. It shows nice. Verizon, Starbucks, Newmont, I think is NEM, Archer Daniels Midland, ADM, and HPQ. Just more to research for everyone. Hey, that's that's interesting. So the VYM, I don't remember exactly what that is. I think that's Vanguard, right? Is that the high yield ETF? And yeah, I like Sven. I did that one. I haven't really watched many more of his videos. I did that reaction video, and yeah, cool, man. Video loves Sven. I'm gonna have to watch that one now. I'm intrigued. I'm gonna watch it. We'll all watch it together right now. That would be something putting on channels from other YouTubers. BCE. All right, Miguel. I like it. Let's look at that. Let's look at share that. Let's look at the tab. So here we go. BCE. I know that's Canadian. They're one of the bigger companies in Canada. Now that's interesting. So one thing I will say here is that they have a dividend safety score of 42. And why did it do that again? Hold on, everybody. Hold on. Hold the phone. I need to do this. I don't know why it changed. There we go. That should make it a little bit better. All right. I'm looking at my phone. I still can't get over this. It's kind of cool that so my phone, you guys are all like 10 seconds behind me. There you go. Yeah, that looks so much better with my screen taking up the whole screen, especially if you're on mobile. I mean, yeah, because you can X out the comments and you got a full screen. So that just looks, I'm sorry. I love it. It looks better. One little step for improvement. So what are we looking at? BCE and 42 dividend safety score, yield of 5.92%. That's pretty big. I know they own, Bell Wireless, Bell Wireline, and Bell Media. They have IPTV. So yeah, they have the landlines. They're the biggest one in Canada, I think, right? Founded in 1880. Yeah, so really interesting. Dividend growth. Let's look why they gave them dividend safety. Interesting. So they increased the dividend during the last recession. Their sales were only down 1%. down 52%. Dividend growth. Yeah, so they actually, I don't know if they spun. No, yeah, they would have. So they cut the dividend during the last recession. But I thought that just said increase, didn't it? See, recession dividend increased unless they went from '08 to '09. They increased it, and that was during the last recession. That's what I can guess. So, yeah, looks like they've been pretty steadily growing it. 5%, pretty much across the board. Look at that. 5% increase in February 2022, 5-year CAGR, 5-year 5% CAGR, and 5% 20-year CAGR is what I'm trying to spit out at you. So 13 years uninterrupted and 13 years growth. Now, again, some of this can be because it's a Canadian company. And as you see here, it shows in, if I can do that, I can't, it won't let me, in Canadian dollars anyway. So there is that currency conversion, and that may have something to play into it. But $2.89 per share. And yeah, they're a little bit expensive if you look at their PE, but the dividend yield is above the 5-year average of 5.51%. So I just want to see if they're buying back shares. Yeah, now I don't know if this is accurate, but it shows a free cash flow payout ratio at 431%. That we would need to dig into. And if that is accurate, that would make me nervous. I don't know why earnings per share has been high, over 70% since 2012. Free cash flow per share dropping. Sales have been, a lot of, this is the aberration in 2020, but they were declining since 2017 though. And they've been adding shares from 775 to 908 in the last 10 years, but their sales have been increasing. So, you know what? I don't know. ROE and our return on in the ROIC, return on invested capital, is just okay. And they have a bit of debt, 57%. I don't know. I don't get the warm and fuzzy for BCE. So what about you, Shamir? You're up there in the Great White North. Do you invest in BCE? Like to know that. Alternative Comcast. I don't know. Comcast just looks a little bit more stable to me. It looks a little better. There you go. Yeah, Dividend Dream. I haven't checked that channel out in a while. There's so many channels. I love it. There's so much information. Nice. I would check that out. Hey, there he is, Michael. What's up, Michael? Yeah, I got your video in the works, man. If not Tuesday, it'll be out Wednesday. Most likely it'll be out Tuesday morning. So that is pretty cool. So thanks again for that super chat, man. And I love the idea. Happy to share that. If you missed it, I'm going to be doing 4 monthly dividend stocks that I think are a buy right now. And one of them is Canadian. So a little bit of a teaser there. Hey, my guy Clowning, dude. Thank you for all the support, all the comments throughout the years. I love it. And yeah. Who's buying AVGO? Broadcom. I think Broadcom's solid. I don't outright own them. Although it's funny, I did invest in my daughter's wedding fund, bought another share of SCHD because I just want to experience so I have money in my 401k through my work. That's where the bulk of our retirement is at. I don't share that. I don't really feel comfortable doing that net worth and that. This on the board is what we've started since we started the channel, which is pretty cool. But 30K of it right in March 2020, I pulled 30K from the 401k and I rolled it into the self-directed IRA. So I only had to pay like $100 in expense fees, I think, or in transaction fees. But it was basically, it didn't create a taxable event. So that's how I have a $30,000 starting self-directed IRA into Schwab. So that's kind of that. BCE. Sorry, I just read something. Yeah. So is anyone buying AVGO? I know they're solid. Let me see what they get. A dividend safety score of 67. They have a dividend safety score of 67. Broadcom does. Here you go. Let's see. Publicly traded HVAC companies. The Deep South and have been without air for 4 days. Really, Stephen? Oh no. Publicly traded HVAC companies. I know that would be Carrier, right? Because they were spun off of Raytheon Technologies. Raytheon spun off Carrier and Otis Elevators. So I know they're one. As far as HVAC companies, otherwise, I don't know. Does anybody else know? I know. Yeah, let's look at Carrier real quick. Come on, everybody. Let's take a peek at Carrier. Let's see what's going on with Carrier. There's the Broadcom I was just looking at. Broadcom. Just looking at the Broadcom, huh? So we're going to look at Carrier. I don't know the ticker, so Carrier Global. Dividend safety score of 60. Yeah, they only 1.67% yield, but it's way above the 5-year. They're growing it fast, so let's see. Carrier. Yeah, HVAC, refrigeration, fire. Let's see if anything pops out. Yeah, refrigeration, digital solutions for trucks, trailers, shipping container. Oh, that's interesting. See, I didn't think of that shipping containers, intermodal. So like all the, warehouse cooling. Anyway, so that is and they own Kidda. That's our smoke detector, carbon monoxide detector. Let's see. So they're a new company. Like I said, yeah, they were just in 2019, they were spun off of Raytheon Technologies. So this only shows 1 year of dividend growth, which I think they need to update that. It looks like it's been more. Yeah, it's definitely more than a year. Come on, SSD, Brian Bollinger. Carriers at 60 cents a year, 15 cents a quarter. And their timeliness. Yeah, only 1.12 5-year average. So they're 49% above the 5-year average. PE is low. And they're at $36 a share. So Carrier definitely looks interesting. See if I get some stats on that. Hey, their free cash flow payout ratio has been ticking up, ticking on up, ticking up. Shares outstanding slightly increasing, and then they just bought back a few. Interesting company. $20 billion of total sales. Return on invested capital looks good. Return on equity looks good. Let's see how their debt is. A little bit of debt, 44%. So that's interesting. That's Carrier, everybody. Does anybody own Carrier? I don't know. Back to BCE. We're going back to the Great White North, Shamir. They own, so BCE owns the Bell Center in Montreal. Uh-oh. We got a Habs fan. Yeah, I'm a Blackhawks fan here. So funny that you're not a Flyers fan, obviously being a Habs fan. And that's pretty cool then. So I guess they don't own obviously they don't own the Canadians, but that would be cool, at least owning the arena where they play in. And that to me gives a different dimension. Thank you for adding that, because I didn't know that. So that's just more revenue for them, hopefully, that they're making from that. Deep dive into AVGO. Yeah, I've never dove really deep into Broadcom. I know that they're a really popular dividend company. But yeah, that would be an interesting one. Maybe I'll put that on the docket. Let me write that down for ideas for future Broadcom. Future idea, maybe for a video. He doesn't invest in BCE, more into TELUS. TELUS, they're like, I think those are the big three, right, in Canada. There's BCE, there's TELUS, and there's one more I'm forgetting, one of the big ones. And it was almost there. I don't remember. Tim Hortons. That's what it was. It was Tim Hortons. I like Tim Hortons. Not a bad little company. Was a former NHL player, by the way, Timmy Horton. Steve looking into LX International. Let's all look together. LII. Yeah, Lennox. Okay. All right. Come on, everybody. Let's go. I don't know what to call it. You have any? Let's go look at Lennox on the Simply Safe Dividends machine. Need like a transition. Okay. LII. I've never looked into Lennox, so this will be a first here. Hey, look at that. Dividend safety score of 90. Almost a 2% yield. I'd like that to be a little bit higher, but $7 billion mid cap. Let's see their dividend growth here. Let's see it. Not bad. 12 years of growth, 25 uninterrupted, 15% was their last growth in May of 22, 16% 5-year CAGR, and 12% 20-year CAGR. So pulling double digits right there in dividend growth, paying $4.24 per share every year, which is $1.06 per quarter. They're going ex-dividend in a month on August 30th. Dividend yield is 69% above their 5-year average. And the PE is well below the current PE 15.3, way below 22.0. And the 52-week range, look at that, man. They were as high as $344 down to $216 now. So, this, let me zoom in on that or not. Doesn't want to cooperate. So this is something that is interesting. A lot of people will look at price and focus on price, but I heard an interesting saying that said there are far more companies that are under $5 a share that are way overvalued than there are of companies. I think I messed that up. I always mess these up. Anyway, the point is there's so many companies that are over $100 a share that are undervalued. So price is not an indicator of overvalued or undervalued. It's always the company versus itself and versus the sector. So if we're like, for this instance, looking at Lennox going off on itself, they're going off on itself. I hope they're not going off on themselves. The dividend yield is 69% above their 5-year average. That's a good sign. The forward PE is below the 5-year. That's really a good sign. And they are below the industrial sector. So you compare a company to itself to other like companies. So in this case, you could compare Lennox to Carrier and then the sector. So when we do those three things, they look like they are indeed at a good price. And free cash flow payout ratio, only 41%. Yeah, I've never really looked at this. Free cash flow's been dropping a little bit. Most companies have as inflation's been ratcheting up, right? They've been having their margins get squeezed. Sales dropping a little bit. Earnings is choppy. But look at that, man. Okay. And this is more of a reason why their share price might seem expensive, is because they have only 37.1 million shares outstanding, where they were at 51 million in 2012. So I'm broken record. I love seeing shares outstanding decreasing and total sales increasing. So that just means there's more total sales to spread around, more earnings per share to spread around over less shares. It increases our ownership stake in those companies without doing anything extra. It's just wonderful when that happens. Interesting, low return on equity. We need to look into that. It's been getting better. You don't need to know why it went from 697% all the way to negative 700%. I'm guessing that might have been either acquisitions, spinning something off. I don't know, but we could find out. Return on invested capital, 42%. And let me look at their debt. I don't know if I believe this. Sometimes these sites can be spotty wherever they're scraping their data from. Always the best place to look is to type in LII and then IR on Google. Brings you to the investor relation page, because I'm pretty skeptical that their net debt went from 95% in 2017 to 18%. I mean, unless there was some miracle there, I don't know, but their interest coverage ratio really good. So Lennox looks pretty interesting, but I would want to investigate why their return on equity is negative. But a dividend safety score of 90, none the less. Miguel was doing some research on AVGO. He'd like to see it come down more before buying. Yeah, I think a lot of people do, but I don't know. We'll see what this CHIPS Act does. It might get that whole sector going back up. Ally. Yeah, Ryan. Hey, let me take a sip. I did a video and included Ally not too long ago in my Buffett video. It was dividends on sale from big old Warren B, big Mr. B. But I'll pull them up for you real quick since you're so kind to ask. Yeah, Ally Financial, actually, GMAC, the General Motors Acquisition Corp? I don't remember. You hear me call like what's it? Anyway, GMAC, which was the financing arm of GM, they used to own uh no, they spun into they Mighty Morphin Power Rangered into Ally. So here we go. We'll make this one quick, but for you, my friend, we'll look at good old Ally Financial. We'll just sing it the whole time. Dividend safety score of 50, borderline safe. Not too bad of a yield. Remember, Warren Buffett, Berkshire owns them. Let's see their dividend growth. 5 years growth, 5 years uninterrupted, because that's when they started out as Ally. They Mighty Morphin Power Rangered into Ally from GMAC. Actually, let me see if I get the details when that was. Why? Hold on. Un momento, por favor. Yeah, here we go. So the company was formerly known as GMAC and changed its name to Ally Financial in May of 2020. It was founded in 1919. So then they started paying a dividend in a few years ago, 5 years ago. So yeah, 20% growth in January, 5-year CAGR of 41%. Really high. I don't know if they can keep that up. Paying $1.20 a share, 30 cents a quarter for Ally Financial. And they do look to be on sale, in my opinion, because their current dividend yield of 3.49% is 58% above the 5-year average of 2.2. The forward PE, only a 4.6. Well, we know the financial stocks, right? The financial sector had been getting hammered. So that is pretty significantly low. Currently paying $4.60 for every $1 of Ally Financial's earnings, and they had been as high as $55 a share, currently at $34.43. So basically at 52-week lows, and they are way below the PE. So by all those metrics, Ally Financial is very much on sale. Their free cash flow payout ratio, though, negative 95%. This is interesting because they're a bank, so you can't look solely at the free cash flow payout ratio, but you do want to see them making money, and their earnings per share has been somewhat declining. Their sales growth has been dropping. They are buying back shares, only 355 million outstanding, and their sales, though, have been increasing. So looks interesting. It's not meaningful, the return on invested capital. I love it that they'll tell you exactly why. So much of their financing tends to come in the form of low-cost deposits from consumers and businesses. So they're doing that. What does Ron Paul call it? Fractional reserve banking, right? Where I think it was 90% they could lend out. Does anyone remember what the number was? He used to talk about that. I'll explain that in just a second. Yeah, you can't look at these net debt. So they live on debt, but interesting. So it could be a good play if you want to turn around. I don't know about long-term for Ally, but yeah, that's, I don't know. That's an interesting one. Does anyone invest in that in Ally Financial? Warren Buffett does. So maybe you're going big Warren A.B. Man, this screen is just stretched out. I wonder why. Stupid StreamYard. But it's okay because we got the nice picture. The big picture. I'm embarrassed off of what I was shown before. Anyway, let's get back on track. Back in the tracking again. Yes, he did just sing Aerosmith and completely muck up the lyrics. Ben, let's see. He has a Lennox. I don't know what we have. I probably should know. I don't know. It's gray and it's outside my house. That's what I have. Altria Group, Ignacio. I like Altria. They're hitting some headwinds, right? So I think that's pretty much why their share price has been down. They aren't able to sell Juul anymore. That had to be taken off the market. But I know that Philip Morris with their, is it V? It starts with a V, right? Philip Morris basically was kind of like a, I don't know how to describe it. So Altria split off from Philip Morris, and Philip Morris was kind of like a healthy competitor, but now it's just looking like they're taking market share. I don't remember. I will look for you, Ignacio Montesino. My name is Ingo Montoya. I have come to kill. Do you remember that from Princess Bride? I don't know. I'm probably. Who remembers Princess Bride? Come on, great movie. My name is Ingo Montoya. You killed. I don't remember it. My wife's probably upstairs. She loves that movie. She knows Ingo Montoya. I did see a shirt though where they sold the "Hello, my name is Ingo Montoya." That's pretty funny. Anyway, we'll let's look. What are we looking up? Altria. They're like, come on, dude, just get on with it already. All right, you waited. Here we go. Let's look up Altria together. Ba-da-da. Got Altria, 55. And I agree with that. It should be safe. They have I know the management wants I think 75 to 80% payout ratio. Could be talking out of my butt on that one, but I do believe that's what it was. 8.57% yield. Let's see. Their dividend growth. So they are a dividend king. This down here, I believe, I don't know why they show that decline. I think that's so if anybody knows, I think that's because of when Philip Morris and Altria split. But honestly, that should have been over a year. So I don't know why it shows that decline, but they don't grow the dividend very fast because the yield is so very high. The payment details. I'm gonna find that out. I want to know why. I'll have an answer for you next time. I want to know why this shows, unless it's a mistake on Simply Safe Dividends. I want to know why they show 1, 2, 3 years of decline after they spun out of Philip Morris. But either way, they're currently paying $3.60 per share per year, 90 cents. And look at that. So their last dividend here, they're due for a raise in October. So the next dividend, they should be announcing a raise pretty quick. And June 14th was the ex-dividend date. They just paid that dividend on July 11th, which was last week. I did receive Altria dividends. So that should be it. This should be it. We'll be curious to see what their next raise is. And if this is any indicator, it's probably going to be, so 8% 5-year CAGR I'd say it'd probably be 5-6%ish is what I'm guessing, but 20% that they're factoring in anyway. And let's look at the timeliness. Yeah, the 5-year average, 6.85%. The current yield, 8.57. They're way below the 5-year average, only 8.5. We're paying $8.50 for every $1 of their earnings. And they are buried squarely at the low end of the 52-week range when they had been as high as $56 a share. And let me see. Yeah, free cash flow, 79%. So that, I believe, is in line with what management wants. And we know they pay out more because Simply Safe Dividends, let me blow that up. You can see that. They recommend, they want to see below 85% for tobacco companies. So Altria, they were as high as 126% in 2016. Is that when they acquired Juul? I think that might have been when they acquired Juul, which is why it went up. And then they started doing that, coming back down. Let me look at their free cash flow per share. They make money. Earnings per share just been going up into the right. Sales been a little bit choppy, coming down. And they're still buying back shares. Very, very gingerly, though, as of late. But they were at 2.02 billion, now at 1.84. Total sales going up. Very high return on equity and ROIC. But I want to see their debt. Net debt has been going up, though. So this is a little bit concerning. They're at 63%, then 81, then 89. So they're taking on a bit of debt, but they are able to pay the interest on that debt. So that is Altria. I would buy more. I don't think they're going anywhere. I think Altria is still pretty safe. And thanks for the question. I don't want to call you Ingo Montoya. Clownin owns Comcast. Great time. I think I'm definitely agree with that. Oh, he deleted that. Okay. Hey, Shamir, you're human, baby. You're a human. We make mistakes all the time, and it's awesome that we could. Oh, this is boy. I don't know if I could answer that. If I had 10K, how would I invest it? Funny you should ask, because I just did a video for my first $100 in dividends. If I had to start over again today, what would I put my money into in my situation? That's not financial advice, but I mean, honestly, it depends on your age, your risk tolerance, what your goals are. But if it was dividend stocks that I wanted to invest in, I'm all about safety for building that base. So I would probably do 90% of that, 95%, and then I would keep at least 5 or 10% for growth, because you want that growth component, like the Amazon, Tesla, companies that don't pay a dividend. And but like we just went over some at the beginning, like those are all companies that I think are great options because they're growing their dividends really quickly. So Texas Instruments, Lowe's, Snap-on, Comcast, and Medtronic are companies that I would give a really good hard long look at because I think they have really safe dividends and they're really growing them pretty quickly. So, but that's a really, really unique question, and you could answer it a million different ways. Rogers, thank you. And we're getting, this is my problem here. I ask a question, somebody answers it, and then I get back. And let's see, Steve C. I'll just tell you the score for TELUS. TELUS is TU. They have a 72, dividend safety score of 72, safe. And their dividend yield is 4.81%, which is just a little bit above the 5-year average. So they get a safe rating. Yeah, Tim Hortons is the coffee chain there. Yeah, when I was in Toronto, Tim Hortons, we hit there a couple times, took the kids. Interesting. Yeah, Ally's kind of risky with all the car loans they hold. That's a fantastic point, Miguel. And I would have to agree that they are, I think, one of the largest car loan financiers, I believe. Pomegranate, right? No, blackberry. Blackberry bubbly. Blackberry bubbly. It's like I'm doing a commercial. I like drinking the blackberry bubbly. It makes me feel very good, and I can do my YouTube videos very good too. Thank you, Bob Bubbly. Somebody cut that. Send it to Pepsi. Cut the check. This guy, he needs something more than bubbly. Nah. Anyway, so does Ally dabble in student loans? That's another area of political risk. I don't know. I don't think so. I do know there are ways to invest in student loans. I don't know if any are publicly traded. That is actually pretty interesting. I love the ideas. Student loans. I'm going to know. I'm going to look. Oh my God, we've almost been on for an hour. That's what we're using. All right, let me blow through these. Let's see. SWK Clownin, Stanley, Black & Decker, Caterpillar, Good, Deere, Leggett & Platt, UGI. UGI owns AmeriGas, by the way. That's who's firing up our grill. I think we're going to have some burgers today. We're going to cook up with AmeriGas, everybody. Come on over. Anyway, let's focus. Comcast. And buy for me also T-Row. Yeah, T-Row. Somebody mentioned they're going to be selling cash secured puts on T-Row. That's interesting. Options, not here or there. Oh, options. Check this out. Let me, real quick. Yes, I will look in 1 second. Mariusz, did I say that right? We'll look at MPW. Yeah, let me see. I'll do a quick overview of them, but check this out. Come on, everybody. Check out this. This is my dividend income on my website, which is just, I've been really slacking on it because I'm so busy with everything. But I share all my options, everything I've done. Currently have made $1,291 in options income. But this last week, starting right here with NEO, $50, I sold a cash secured put. So $51 is what the contract was for. But Schwab, you have to pay 65 cents on every contract, on every option. So I'm always losing 65 cents. So I made 50.35. But PepsiCo, I think it was around $171 a share when I sold this. We're bubbly talking again. That was I got $14, $13.35. I'm pretty far. I think the cost basis is $150 a share. So I don't really want to have those shares called away, which then I would just sell cash secured puts aggressively and get back in. It wouldn't be an issue. But if PepsiCo were to be called away, I would be paying I would have to pay capital gains tax on that because it's in my taxable account. So I don't really want to deal with that. So I'm being very, very cautious. And if I can get an extra 10 to 15 bucks a week out of Pepsi and not really have to worry, I'm doing that. And then Starbucks, I got another 20 bucks out of that. So one in the Roth, one in the bridge, and one in the SD IRA. So I don't remember why I brought that up, but I could have kept sharing. All right, I want to get to your question, Mariusz. I think I said that right. I think so. I'm Polish, by the way. I'm Polish and Czech and a little teeny, did he say teeny titty? Teeny tiny bit of Swedish. Let's see here. Okay, we'll wrap this up soon, but I want to take a peek here for you. Mariusz at MPW. That's Medical Properties, right? Medical Properties Trust. They have, let me make it big for you. Make it big. This guy's a nut. 70 dividend yield of 7.36%. And they are non-qualified dividends. So really quickly, what that means non-qualified is that they are a REIT. See up here, I'm going to read healthcare REIT. So they're a REIT means that they pay out 90% of their earnings in the form of a dividend. And when they do that, they don't pay taxes on, I believe they don't pay taxes on that income because you do. So that's why they're not qualified, is they're not paying the taxes. They get to maintain that kind of tax haven status, tax-free haven status, but we pay the taxes, but they have to pay out 90% of their earnings in the form of that dividend. So in a nutshell, that's why REIT dividends are not qualified. And let's take just a quick old peek here at their dividend growth. Well, it looks like during the recession, they had a couple cuts there in the last recession. Very slow growth, though, 3.6%, 4% 5-year CAGR, 3% 10-year CAGR, but 9 years growth. So I think if we hit a recession, I wouldn't be surprised to see them cut that dividend. Currently $1.16 per share. Again, the taxation is non-qualified, 29 cents a share. And let's see if they are. Yeah, they're definitely on sale. 15 bucks a share. So their current dividend is 30% above the 5-year average, and they're way below. That is the price to adjusted funds from operations. Because they're a REIT, they have to spend so much money. So you can't look at, again, the free cash flows. So a little bit of a tricky thing. Won't get into that too much. But they're increasing shares. I wanted to point out for REITs, don't worry about REITs increasing shares. They need to bring in more money, because when a company puts more shares on the market and sells them, they get money. And that's the only time they get money from stock shares, unless they're trading their own shares, I guess. So that's why you'll see companies issue shares, because they need more money. But the negative thing is it's diluting the shareholder, because it's the opposite, obviously, of the buybacks. There's more shares out there. So they need more money. They're bringing that in. So if they're bringing in more money by diluting you, they should at least be increasing sales, which up there, see, up and to the right, and then up and to the right, their total sales. So that's almost in line, you can see, with them increasing shares. So that's not really that big of a deal. And anyway, so they give a safe rating. So I guess that would need more investigatory practice into that or something. Yes, Daniel, he's getting back to the comment I made like 30 minutes ago of Princess Bride. My name is Ingo Montoya. And, oh my goodness, Freedom Stacker again. Here, let's see. You kill my father, prepare to die. Yes, that's it. Never go against a Sicilian. I love it. See, just got to mention the movie. Here we go. Davy Jones. Tell me you're in the Navy, baby. Tell me you're in the Navy, Davy. Moses, they just lost Jewel. Anyway, yes, they did lost Jewel. So, but we've got a super sticker from, you know what? I don't know what to do with a super sticker. Do I pin this? What do I favorite it? I don't know what to do with a super sticker, but dude. Hey, thank you. I don't know what to do. I wish there was like something I could do, like streamers raining down and jazz hands. I don't know what, but dude, thank you. Seriously. I mean, I didn't see that till now. Thank you so very much for that. I really do appreciate that. Yes. If you want me to look up something, let me know. I'll stick on for another minute more since you're so kind to do that. I really do appreciate that. Thank you. From my family to yours. Thank you. Um, oh, I did use a, yeah. So Shamir, yeah, anyway, let me see. Starbucks is unions. Yep, that's something that's kind of interesting that's been going on. Howard Schultz. I almost said Howard Marks. He's from Oak Tree Capital. Not to be confused with Howard Jones, right? What is love? God. Anyway, so Howard Schultz, the Starbucks CEO, he he's kind of been pushing back hard on the unions, and he's in the last in the last um, in the last conference call, he said, "You know what? Feel free, go ahead, unionize, but do be aware that if you sign that contract with the union, we can't increase your benefits or your pay without renegotiating a new contract, which is really not very easy to do. But if you're a non-unionized employee, we can just go ahead and give you more money and benefits just willy-nilly because we like it." So it's kind of a veiled threat, and it's really interesting to see how this is going to play out. I'm not going to take sides here, but just do be aware that yes, it is definitely interesting. So, oh, dude, see, what is this? Somebody else gave me another tip. I'm learning how this works out. How do I get to this comment? Dude, sorry. Where is that? Yes. Dude, Steven. That's a little bit of boxing dancing for you. I don't know what I need music to dance. I have to feel the music, and then I can, wellspring it out in my dance moves, but we're just going in my head. So, dude, again, man, thank you. I wish I had flashing lights and streamers. And really quickly here, I got to put this on. This is my guy. This man I have learned so much from, the EDGI. Again, he is another anonymous person, so I always have to be careful. This person, follow him on Twitter. Definitely subscribe to his YouTube channel. Listen to the podcast. He does the Dividend Talk podcast with Engineer My Freedom, and they are Eurocentric, European flair and flavor, and thoughts and ideas for their investing. And even though I'm not in Europe, I've learned so much about European companies, and it really does add just a really different dimension. So make sure you subscribe. Look up this guy. There we go. This guy right here. Very cool, very interesting stuff. You gotta check that out. And all right, let me get through these. Let's see, Shamir. Yeah, I'm thinking of doing a thing. So, on my thumbnails, I've been experimenting thumbnails with me, some without. And my wife wants to just take like 50 pictures, just change have like 5 different shirt changes, just different expressions, like whatever it is, make all those silly YouTube. I hate it, but I'm learning. It's part of the YouTube game. And I'm just telling all you guys, it's just part of what I think you have to do, because when I'm scrolling, we catch, your eye hits that thumbnail first. So I've been learning the psychology that our eye is drawn and we connect with human emotions. So that's why on the one about my Celsius, I did kind of the destitute, which, thank you everybody for your condolences anyway, for the money that's probably locked up. But anyway, yeah, I got that Labatt shirt from London, Ontario when we went to Toronto a few years ago on a family trip. JEPI ETF is a security. I don't know if it's a security. They hold securities, right? So it's a popular one around the dividend investing community. I'm sorry, man. I'm just moving on. I'm over time. I want to just, let's see. When I sell covered calls on my positions, what delta do I aim for? So with delta, he's talking about, Ivy, what do you want? Come here. What? My daughter's here. Say hello. Wave, please. Come on. Come on. Oh, she's no fun. Please. No. Why? Because I'm looking for mom. People want to see you wave now. Come on. No. Dude. she's no fun. Oh, I should have grabbed her. Anyway, she's going into freshman year in high school and says she's in her pajamas. Loaf. The delta I aim for. So the delta is basically look at it as the percentage that it's going to exercise successfully. So I think when I did PepsiCo, it was like a 0.17, which means it's about a 17% success rate, which means that the numbers are way on my side. But if it was like 0.80, it means there's an 80% chance of exercising or landing in the money. So I don't really have a hard and fast number. I just, it depends, right? So with PepsiCo, I want a really low delta, but when I'm doing Neo, I really don't care because they're in my wheel. So if the shares get exercised, then I just sell a covered call. And then if those get, because I'm trying to get more premium. So that one, I'll do a higher delta, but it all depends on what I'm selling. Do I trade NASDAQ listed penny stocks? I don't trade any penny stocks. I did buy Voyager though, because I just got bit by the bug and thought they might pop. So penny stocks, I'm out. Penny stocks I used to do when I first got into this because I wanted that hard, fast money. And dividend investing is the opposite of that. It's really, really getting rich slow. So no penny stocks for me. And God bless all the people that say they can make money off penny stocks. Garen, thank you, man. Thank you. I appreciate it. I'm enjoying this. It's been the quickest hour and 10 minutes of my life. Too bad BGS is not a read. That's a little bit of fun here. I'll just tell you what their shares were. So yeah, I know BGS, they dilute everybody like nutty. Yeah, they have a 40, an unsafe dividend score, 8%. And their shares were 49 million in 2012, up to 66 million. So they do definitely like answering the shares. Oh, name pronunciation was close. Well, good. That was just a guess. So I'm glad I could get close. Poor BGS. Yeah. Again, Steven, with that sticker. Again, I thank you, man. Trying to get caught up here before we bug on out. Oh, LYB, Lyondell Basel. Yeah, I own Lyondell Basel. I'll look at them for you real quick, Josh, because I don't mind this. Like, I enjoy this. Too bad my daughter wouldn't say hi. Silly. I tell you. What are we doing? LYB. Isn't it funny? I'm an introvert, so I'm wiped out after this, but I enjoy it. I like talking to all you guys. It's a fun time. LYB, dividend safety score 51. I know they're a cyclical company. I do have concerns that in a steep market or a steep cycle decline that they could cut the dividend, but they did increase it 5%. They also paid out a really nice special dividend. It's not what I wanted. Dividend growth, 9 years. They're almost a dividend achiever, which is what you get after 10 years. 5.3%, 6% 5-year CAGR. Payment deals, yeah, $4.76 per share, $1.19 a quarter. June 3rd was their ex-dividend. And timeliness, so they are on sale, definitely on sale. They are at the low end of the 52-week range, which is funny because they had just been at the high end. And I thought about selling them, but we'll hang on to them for now. But yeah, only a 5.1 PE, very low. Dividend yield is 24% above the 5-year average. Oh, what do they do, by the way? They are, they're like polyphins and olimers. They're plastic, so they're really tied into the, petrochemicals. They're really tied into oil. And let's see, I'm not going to read this, but basically like plastics, from what I understand it. They make a lot of the compounds that go into plastics. So I always said, like, when you see here, plastic cup, plastic, there's just plastic all around us. They are involved in that. And I believe they are I don't know. This is interesting. I guess you could go back and watch this and just pause this whole write-up, but you can Google Lyondell Basel. But let me just see their free cash flow payout ratio, only 23%, but you see how they were at 96% in 2020. That was COVID times, and really good free cash flow per share right now because oil had been so high. and they're at only 333 million shares. They had been at 577, so they're buying back shares. Sales, you can see this is a cyclical company. Their total sales, I know oil had been, I can't make this bigger. What's he doing? Oh my God. Oh my God. Let me move this over a little bit. You see, what is this guy doing? So total sales, now we're ginormous. Hello, total sales. Yeah, so it's cyclical, right? So they're down, then they're up, then they're down. Now we're up. We're in an up cycle. So my only concern is if there's a sustained down cycle, what will that do? And that will be seen. But pretty good return on equity, return on invested capital. 49% debt. Their debt, they've been paying it down since 2020 when it was at 68%, 53, now 49%. That's a good sign. I like to see like a lot of oil companies are using this influxing cash from the sector that just was making a lot of money. They're buying, paying down debt and buying back shares. So LyondellBasell, $16.27 for every $1 of interest expense. Anyway, those of you that are just joining us really quickly, this is one of my favorite metrics, the interest coverage ratio. It tells us how much money is available to basically service the debt. So this shows that 16.27, again, there's $16.27 of operating income to easily cover every $1 of interest expense. So there is no issues right now with them paying the interest on their debt, but you can see cycles, they cycle through. So let me get caught up here on a few. So I like Lyondell. I'm going to hold. I may actually add a few more because they're so low. But that being said, don't be surprised if there's ever a sustained, like in 2016 when oil was just going nowhere and it was down. So what do we got here? Adam. Everyone's starting with indexes like S&P 500. Yeah, if you're new, so actually, Adam, trading, I don't trade. I guess I sell options. That's probably the closest I get. But when trading, that means we're buying something at one price, hoping to sell it at a higher price or cut your losses if it starts moving against you. That's in a nutshell trading. I'm not trading. I'm buying shares of, say, Johnson & Johnson, and I plan on holding that for 20 years, just constantly holding those shares. I don't plan on selling unless something fundamentally changes with the underlying business that completely negates my reason for investing in the first place. I don't want to sell. And that's the beauty of it. And I only found that because I tried trading and because I really sucked at it, because I fell in love with positions I held. I wanted to hold them and I'm supposed to be trading them. So it didn't work out. And then I found dividend investing. And because of that, I love it. It fits me like a glove, hand in glove. That's Morrissey and the Smiths. What was I saying? Oh yeah. Look how quickly this guy loses his track. Anyway, about trading, I was talking to you about. Yeah, I'm not trading. I am investing in businesses. Because remember, when we buy a company, when we buy a stock ticker, we are legally owning that business. Like it's literally buying a business. And I think a lot of people lose sight of that. So you can trade, but I'm really bad at it. And I'm just so awesome at maybe to a fault sometimes. But in the world of this game of dividend investing, it really helps. I just buy companies I love, like PepsiCo. I'm buying the business. I look at it as I'm owning that business. I am a business owner and I plan on holding them forever unless something should change. So as far as that, if you wanted to invest and while you're learning, I would say SPY, like that's a pretty good place to start. You're buying 500 top businesses in the US index, or VTI or VTSAX. Those are kind of the same two things of Vanguard, but one of them is, I don't remember the difference. My brain's fried. So if anyone look into VTI, VTSAX, or just make it easy and do SPY, ticker SPY. Let's see. What did I just witness? Oh, I don't know, dude. That was a few minutes ago. That was probably the dancing, right? Some singles. Yeah, buddy. Oh my God. We're goofy here. We're goofy. Starting to trade too. Yeah, covered call. Yeah, SPY, good one to start off with. And yes, I don't know if you're still on EDGI. I'm just rambling now. So, what is that? Oh, it's the wave. Hi. And again, thank you for that donation, Freedom Stacker. That was too nice. Uh, One Up on Wall Street or Beating the Street. Yeah, you can listen to them on YouTube. Or, Adam, if you're in the United States, I will type this out now for you to remember. Hoopla or, is it Post My Account? There it goes. Or Libby. Those are two apps that I would strongly suggest reading. So Hoopla or Libby. And if you have a library card here in the United States, you just put your library card number in. Free audiobooks. I do like Hoopla a little bit better because you get your stuff right away, where on Libby, you have to kind of get a queue if the book's not available, and it might take a month. So I actually was just reading again One Up on Wall Street by Peter Lynch. Just great. So everybody, if you're in the United States, you have a library card, check out Hoopla. And if you don't have a library card, what are you doing? Go to your library, get a library card. All right, we'll run through these a little bit quick here. Lost 10 grand on penny stocks and 3,000 on Voyager. Again, I bought those 100 shares of Voyager. I'm down a little bit on, and I would say I've lost a couple thousand on penny stocks before I learned my lesson. I really, I remember people saying like, dude, you just get in so quick, so out. Here we go. I like it. 39K this year, low float IPOs, not necessarily penny stocks, but very manipulative. Hey, man, you know what? Dude, that is awesome. I would never knock it. And if you can make money trading penny stocks or your low float IPOs, dude, do it. Do it all day long. And, well, you can't trade on twice on Sunday. But, and again, it just goes with knowing what kind of trader you are. But it was too hard for me. I couldn't follow systems. I always broke my own rules, and I wasn't sleeping easy because I would lie awake at night. And I've told this story with Neo when it IPO'd. I'd be up at 4 a.m. when the market opened, looking at the pre-market to see if it was going to go up. It just wasn't for me. So it was not for me. Hoopla and Libby. Yeah, YouTube, it is hit and miss, but dude, the apps, Hoopla app and Libby app, gotta check it out. I highly recommend it. So, holy cow, 1 hour, 22 minutes, and I'll leave the floor open for just a few more seconds. We'll go 1:30 as I take a sip of my bubbly, and we'll see what you guys have to say. But if anybody wants me to look up one last thing, I'll do it. You want me to comment on something? You got any questions? Till next week. This Saturday, I will be going with an old friend to a fight in Willowbrook, Illinois. There's an MMA fight. Haven't been to one in a while. And for all of you veterans, I did get that on VetTix. That is vettix.org. You are a veteran or you know a veteran, definitely, I'll show you guys what that looks like really quick. If you know a veteran or you are a veteran, share that screen. StreamYard, share screen. Here we go. Let's see. Here we go. There it is. So if you are a veteran or you know a veteran, this is something I've been using for probably 5 years now. Venues and people will donate tickets to all kinds of different things. And you put in, I'm not going to log in, but anyway, so just remember vettix.org. You can get free tickets if you are a veteran. You have your DD214, you plug it in, they do that quick thing, they ensure that you are a veteran, and away you go. So VetTix is really cool. Domino's Pizza DPZ. I don't know. I do like it. I like Domino's better than Little Caesars for those cheapy pizzas. I like it a lot better. But I think they're a solid company. They have, I heard Toby Carlisle talk about it not too long ago, and he had some really interesting things. It was a while ago on a podcast, but I'll look it up real quick. We'll share. Come on, everybody. I'll look it up for you, Ben. Domino's Pizza, 55 dividend safety score, only a 1% yield, so that's kind of low. although they do grow it fast. 17% March 22, 5-year CAGR. Looks like they cut the dividend during the last recession, didn't pay it. But currently $4.40 a share, $1.10. So again, low yield. And their PE is pretty much in line. It seems expensive, right? 29.9. That PE seems like it's pretty high. And their dividend yield is 22% above. I probably wait for it to drop a little bit more. And I don't know if we will. Their recession sales were negative 5%, but check this out. Their recession return was negative 66%, while the S&P was negative 55. So I think if we head into a recession, that dominoes is probably going to fall a little bit more. And how much am I invested into financial stocks? Well, let's look real quick. I'll end this with going into the portfolio on Simply Safe Dividends. So let's see here. I will go to top. Let me make it full screen and portfolios. No, that's not. That's their portfolios. My portfolio. Financials. I think I can sort it by sector or not. You know what? You can look through this with me. We'll just go. I think there was a way to do it by. Yeah, they got a ton. I really love Simply Safe Dividends. It's expensive, but I'm happy I can share it with you guys. So currently, I know what I can do. Here, diversification. There we go. Duh, I knew there was a way. Okay, here's my financial stocks, which is, so we have JP Morgan Chase. Let's see. Let's start at the percentage. So Prudential Financial, 1.6% of the portfolio. I like Prudential. They have come way down, 5% yield. JP Morgan, we own in the self-directed IRA, currently 0.9%, 3.5%. That yield is above their 5-year average. And I can't, so myself, see, that's why it helps to have my phone here because I'm blocking the bottom three. So I will sort it in reverse then when I get it past MetLife. So MetLife is 0.5%. I know there's a way to toggle. Anyway, so MetLife, 0.5%. And the other ones are Voyager, which again, this was my penny stock trade. It's in the Roth though. So they're bankrupt. They filed, that's why they have the Q at the end. They filed bankruptcy. And MetLife again. Oh, okay. They didn't combine it. So I have MetLife in two different accounts. So that's it. I have Prudential, JP Morgan, and MetLife, and technically Voyager Financial are the financial stocks I'm invested in. All right. Have a great day. All right. Hey, Lala, she was making fun about the poppy. She thought it said poppy instead of Patty. So yeah, I think that's it. I've been on too long. I think an hour and a half is way too long, but you know what? And I know I don't expect everyone to hang out that long. I really, really do enjoy just chatting with all you guys. I love seeing it. And it is, it's a weird thing because it's so strange. I'm talking to a camera and my only way to see you guys is the comments. So Clarence, yeah, I don't even remember answering your question. That's how rapid fire this goes around here. So yeah, cool guys. And I don't know, I guess I'll give it 2 minutes, an even hour and a half. We'll end it there. We watched Creep 2 on Netflix. If you want a kind of really cool, low budget, psychological / thriller movie, I guess, look up Creep and Creep 2. It's with Mark Duplass. He was in a show called The League. It's a fantasy football reference. So yeah, if anyone has anything to say, let me know in the next 1 minute and whatever seconds or 2 minutes, we'll, hey, Miguel, you're welcome, buddy. I would like to make these quicker and I hope that it went pretty good in the beginning. Oh, look at this. It is episode Stranger Things. Oh, I thought you said, yeah, EDGI. We just wrapped it up. My kids enjoy it. I don't watch enough with the kids, but I think I don't want to say your child. I think you watch it with your child. I always feel funny when when my fellow creators want to be anonymous, I got to be careful what I say. But yeah, it was kind of fun to watch it with my kids, and we get to share that kind of like that journey together. It was something. It was fun. Oh, look at this, Lala. Yeah, that's a great point because women are case in point. I do none of the shopping. My wife does all of the shopping, and she knows prices. Right now, we could play a game, and I bet you I would not even get close to knowing what a gallon of milk is, a stick of butter, a gallon of milk, a stick of butter, and a carton of eggs, right? The Sesame Street thing. Oh, 10 years, yeah. That's funny. My daughter, she sometimes she's like me, really active imagination, and she'll like sleep within her older sister's room and some stuff. But all right, man, I think I'm gonna wrap up. I could just sit here and talk all day and just flap my gums, but yeah. So again, everybody, I really do appreciate it. Thank you for all the donations, and thank you for swinging by. And again, this guy, let me say, get it. This guy right here, go right now. If you're not doing anything, make sure you subscribe to his channel. He just dropped the video. I didn't get a chance to watch it yet, brother, but check him out. Check his podcast out on Stitcher. And yeah, there's not enough people around talking about dividends and dividend investing. So I love you guys. Thank you. And I will see you all in the next one.